makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The slowdown in U.S. CPI bolsters bets that the Fed is near the end of raising rates. Doubts remain about the persistence of slowing inflation. China's exports fall for a second straight month in June, adding to the economic pain that has hampered the nation's recovery. Plus, the UK economy shrinks less than expected in May as consumer spending proves resilient and labour strikes ease. Now, also coming up on our weekly Bloomberg UK show, a deep dive on Britain's plans for startups and an exclusive interview with TikTok's general manager for operations in Europe. But first thing is first, so let's get straight to some of the overview of the markets. This is the European markets map. A lot of the focus, of course, on CPI, so dollar, which we're seeing moves across the board. Investors still responding, of course, to that important CPI data that was released yesterday, showing that the inflation rate actually slid to a two-year low. That's really easing some of the worries out there in certain parts of the markets of higher interest rates and a potential recession. The question is, we haven't really seen a huge repricing when it comes to cuts. Does it still mean higher for longer? And what happens after the next move? The picture across the board, you can see the UK, the FTSE, the DAX and the CAC gaining between 0.2%. We're also getting some breaking news out of the IEA. I'm really looking forward to our conversation with Toril Bosoni shortly. It's cutting its global oil demand outlook for 2023 as they think the economy is staggering. I think it's important to then really try and break it down, whether this is weakness in China, because we've also seen some encouraging figures in terms of oil demand into the driving season in the U.S. Now, first thing is first, joining us to discuss the markets and really that CPI print that kind of changed everything, or potentially could change everything, is our Valerie Teitel, our markets reporter. So, Valerie, good morning. When you look at the market reaction, really to that soft U.S. June CPI figure, does one data make a trend?
Look, this was a really good print for the Fed. Not only did it come in soft, but those key components, the sticky core services ex-housing components, fell quite rapidly. And all of this happening without any labor market pain. It really gets you thinking that there is a big dent in that argument now that the hard work of getting inflation from 4 to 2% is still out there. Now it doesn't look that hard. It's falling without any labor market pain. Perhaps this is just opening the door a bit wider to the soft landing. But the market reaction and the fall through today is a positive one. The key for me is that two-year yield is dropping another 10 basis points in this session. The dollar is roughly unchanged, but it did move so much yesterday, had one of its worst sessions this month. That's as we reprice our Fed expectations that it's one and done.
Yeah, some say it's almost too good to be true. What about inflation in the UK? The Bank of England governor is also expecting to come down, but it's a little bit stickier than elsewhere.
Yeah, the UK is still in a different bucket. We're getting these positive economic upgrades, but it's not really good news for the UK consumer or for the Bank of England, because the longer the UK economy stays strong, the more entrenched inflation is going to be. You know, we do get UK CPI next week. Core CPI is still hanging out on a 7 handle. And these expectations for where the Bank of England Bank of England base rate has to go keep going higher and higher. 6.5% is where we are now. Some banks calling for 7%. That's going to be painful for the UK economy down the line.
Valerie, thank you so much. Valerie Teitel there, looking at US CPI and, of course, this GDP out of the UK. We also have a podcast with Adam Posen, and he's saying, look, we could see a terminal rate of 7% in the UK. Now, off the back of that IEA report, we're also very pleased to have this conversation on oil with the IEA head of oil markets, Toril Bosoni. Toril, as always, thank you so much for giving us a little bit of your busy schedule. First of all, talk us through where you're most worried about demand. Is it China and some of the Asian economies?
Good morning. So as we see in this report, we have revised down our global forecast for 2023 for the first time this year. We're seeing weakness, especially in Europe. As the manufacturing remains weak, we're also seeing some negative sentiments in China. But Chinese demand has been holding up very strongly. And now the expectation for this year is that Chinese oil demand growth will be 1.6 million barrels a day, and that's 70% of the global total. So while the economic outlook for China remains fragile, the recovery is losing steam, as we say in our report, the oil demand is really holding up. We're also seeing a lot of the growth in China coming from the petrochemical sector, and this is putting steam cracker margins in the rest of the world under pressure. So we have lowered our forecast for oil demand in the Middle East that normally, and other countries that export petrochemical products to China. We're also seeing weakness in Africa, where higher fuel prices are putting imports and demand under pressure. So it's a mixed picture. Oil demand growth, as I said, we have revised it down, but we're still expecting 2.2 million barrels a day of growth this year, which is robust, but is slowing into the end of the year and in 2024.
So, Toril, does the global market stand to tighten quite considerably in the second half of the year?
Yes. So far, as we say in our report, the OPEC cuts that were put into place last November has so far been offset by increased supply for other producers. We saw core OPEC plus producers cutting production by about 2 million barrels a day from October through June. But at the same time, we see increased supplies from other producers, including Iran, has increased production by about 500,000 barrels a day over the period to reach a 5-year high. We're also seeing higher supplies from the US, natural gas liquids, seasonally higher biofuels, other producers such as Brazil ramping up production. So far, those cuts from OPEC plus producers have helped supply, been offset by higher supplies from other producers. But from this month, the additional cut of 1 million barrels a day from Saudi Arabia, lower exports from Russia, will lead to a steep decline in supply for this month and next. And with demand rising seasonally, we see a global oil demand increasing by 1.6 million barrels a day from the second quarter to the third. And with limited gains in supplies from other producers, we're expecting a sharp tightening of market. OPEC production can be about 2 million barrels a day below the demand for its crude this month, 3 million barrels a day in August. So a significant tightening for the second half of the year.
But Toril, is the IEA actually disappointed about Saudi Arabia's decision to prolong the production 1 million barrel a day cut into August?
It remains to be seen. As you mentioned in your introduction, the demand is under pressure. We'll have to see how things work out. But and OPEC meets on a monthly basis, so they of course have the ability to increase production again if the market tightens sharply. We are seeing those cuts putting pressure on prices already. In the last few days, crude price has been up by about $5. We're seeing increased pressure on the sour market with the Asian benchmark Dubai and Urals, Russian Urals, increasing more than the light sweet crudes in the Atlantic basin. So we are seeing a tightening of market, which could have a negative impact on the global economy and oil demand. So this is something that we're watching very closely.
I mean, does Brent's rise to $80 yesterday, mark a turning point for where oil prices are headed?
I think so. So far, for the past 4 months, we've seen crude oil prices trading relatively narrow band, as the market has been more or less balanced. But this is about to shift, and we're seeing that now. Oil on the water has come down markedly. It is going to translate into lower inventories on land. And as demand increases seasonally, we do think that there is a risk that prices will continue to increase into the third quarter and the remainder of the year.
So could consumers actually brace for some of the renewed price gains in the months ahead?
Of course, there will definitely be volatility in market. We see that as inventories, OECD inventories are still below the 5-year average. The buffers to deal with increased demand seasonally, demand rises seasonally in the US as the driving seasons, Europe heading out for vacation, jet fuel demand, road travel is increasing. And with supply tightening at the same time, we definitely see the possibility of volatile market and a potential upward pressure on prices.
Toril, as always, thanks so much for joining us. The IEA head of oil markets, Toril Bosoni there. Now, coming up, battered by rising interest rates, we'll ask if there are any green shoots for the leveraged finance sector in Europe. That's coming up next, and this is Bloomberg. The conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Now, the outlook for the European leveraged finance sector is deteriorating. That's according to a report from Fitch Ratings. The agency sees default rates continuing to rise as slowing economic growth and rising rates prove to be a strain for highly leveraged borrowers. Now, while my next guest agrees there are downside risks, he also believes there are green shoots in the leveraged debt market as issuance volumes recover. Well, Rudnicki Schlumberger, head of EMEA Leveraged Finance at JP Morgan, joins me. Thank you so much, Daniel, and welcome to the program. So you see some of these green shoots, but actually the economic environment is tough for some of the products and certainly for leveraged finance. Where do you see the green shoots?
Well, Francine, first of all, thank you for having me here. Green shoots, first of all, in terms of issuance volumes. We've reached a bottom late last year, and now we're seeing more issuance. Every quarter is better in terms of issuance than the previous one. That's very much driven by refinancings. And typically, we're a market where refinancing and M&A related financing are half and half. 75–80% of the financing we've seen this year are refinancing simply because the smart money has realized that now is not a bad time to refinance. We're having this conversation with
Which
CFOs.
is counterintuitive, actually, right?
Exactly. A lot of CFOs would tell us, okay, debt is very expensive.
Yeah.
Wrong. Debt is actually not expensive. Debt has returned to its long-term average. Spreads are actually slightly lower than their long-term average. If we have a real recession, spreads could be 300 to 500 bips higher than where they are today.
But you have to be pretty confident in your business model to be able to refinance now because you don't know what's coming in 12 months.
Well, but you're taking more risk by not refinancing, right? There's a lot of uncertainty, as you said, macro, geopolitical uncertainties, quantitative tightening. The ECB has 5 trillion of balance sheet to reduce, mainly invested in bonds if it wants its balance sheet size to go back to where it was. So the cost of debt could actually be quite a lot higher. You, as a CFO, you could look quite smart having refinanced this year.
And also quantitative tightening, right?
Yeah, quantitative
because of that, and that will, of course, continue. What's surprising you the most when you look at where we are in the cycle, and I guess some of the pipelines going through, some of the refinancing, everything seems to be holding okay. Is that a surprise?
So far, so good. Now, one of the beauty of our market, in particular the high-yield market, is that it's self-healing, right? 400 billion of high yield issued in Europe, yielding on average 8%. That's 32 billion of interest, which generally, if there are no outflows, are going to reinvest itself in the market. So there's an ecosystem. Refinancings can get done. Even acquisition financings can get done today.
But I mean, it's self-healing unless it all comes crashing down. And there are concerns, for example, about commercial real estate in certain pockets. Again, when you look at some of the high-yield leveraged finance, are there certain sectors where you worry about viability in 12 months, 18 months?
Look, I'm not sure if it's leveraged finance specific, but obviously certain sectors like more consumer-exposed sectors are more worrying than others. That said, the need to refinance is there for all of these sectors, and looking forward to 2024, 2025, sometimes even 2026 maturities is something we're engaging our clients to do, and which is explaining the current revival we're seeing.
So when do you these are green shoots. When can you actually say, look, victory, we're done, we're in a much better footing, like maybe we were like 4 or 5 years ago?
It's going to take a long time. Our cycles are usually 7 to 10 years. Yeah. And we're, in my view, at the beginning of a fairly long cycle. Leverage levels for new transactions have gone down. Cost of debt has gone up. We're starting to see M&A activity and M&A related activity picking up. Yeah. But it's going to take a long time to go back to the levels of activity of, say, 2021.
So what's been holding back M&A? And there's one thing that's quite surprising when we speak to chief executives, that there seems to be a mismatch in what buyers are ready to pay for a company and the ones that are ready to, to sell for. Is that because interest rates and the risks of the economy basically turned quite quickly?
I think like all private markets, it takes time for buyers and sellers' expectations to adapt. Oh. I would say for the 2022, the lack of financing or the difficulty to finance transaction probably was one of the main causes of M&A slowing down. That's not the case anymore. Debt is there, and we're starting to see very large transactions, say, the take private of Software AG in Germany by Silver Lake, that's a $3 billion plus LBO, or in the US, Univar, acquired by Apollo for more than $8 billion. So large M&A is doable. The key, as you said, is finding that middle ground between buyers and sellers.
But you also mentioned sectors that everyone's talking about at the moment because it's skewed toward technology. So does it make a difference in what industry you're operating?
Yeah, non-cyclical sectors are a lot easier to find.
What's the one thing that you think will surprise? So we talk about US inflation coming down, so maybe interest rates won't have to go up as much as maybe some in the markets thought, but then they could stay here for a long time. What does that mean for the kind of, how does it impact your industry?
Look, I would not over-index and overvalue short-term changes. Yeah. We have a longer-term perspective. Short-term, it's good. The current spring of leverage finance is continuing. I think the uncertainties, the medium-term uncertainties we discussed remain.
When you look at private markets in general, again, there's a lot of concerns or questions about valuations. Is there anything that actually makes you uneasy about the next 12 months? About something breaking in certain parts of the market?
Look, a lot of things could happen. What we can do, what CFOs, what owners of companies can do is be cautious, look at their long-term financing needs, be prepared for uncertainty. We're going to remain in an uncertain environment. And if they are, they're also going to be able to benefit from these uncertainties.
And Daniel, does it make a difference if you're in the UK or if you need to refinance, of course, in Germany and France? I imagine the macro environment that impacts your thinking, influences you in different ways. The
euro market is deeper, certainly, than the sterling market, although there have been high-yield bond issuance in sterling. Where your end markets are matters as a credit matter a lot more than where your company is located. And there are a lot of great UK businesses with very international operations that have been tapping the leverage funds markets on a regular basis, including the past 6 months.
Daniel, thank you so much for coming on. Daniel Rudnicki Schlumberger, their head of EMEA leverage finance at JP Morgan, for a robust conversation on debt and leverage. Coming up, we'll discuss what we've been learning from a busy NATO leader summit in Lithuania and what it all means for Ukraine. That comes next, and this is Bloomberg. Welcome back. Now, NATO has wrapped up a 2-day summit in Vilnius, signaling Ukraine belongs in the alliance, but falling short of a clear timeline for membership. Now, despite initial tensions, President Zelensky thanked allies for their support and hailed G7 security guarantees for Kyiv. Meanwhile, President Biden, who's in Helsinki today, reiterated allied support will not waver. Now, let's get more from Bloomberg's Maria Tadeo in Vilnius. Maria, I don't know whether the summit is a success or not, but certainly President Zelensky was pretty disappointed yesterday.
Yes, and Francine, it's always the toughest question to answer. Was it a success? And a lot of it has to do with the expectations, but also the management, and at times the mismanagement of the expectations. But if you think about the key topics going into the summit, one was a fundamental show of unity when it comes to NATO. And yesterday, President Biden repeated, when the United States says we will defend every inch of NATO, we mean we will defend every inch of NATO. The other big topic was, of course, Sweden, and we have seen that President Erdogan has now given that political go-ahead to the country, although now he says the ratification may take longer than expected. He suggests that the Turkish parliament could vote on it at the end of September, maybe even October, so they will have to wait until it goes back into session. And then, of course, and you alluded to this, the toughest question, the most difficult issue to tackle, Ukraine and NATO. We did see real frustration from President Zelensky, especially at the start of the summit, a very angry tweet in which he said a lot of these topics and some of the arguments that we hear are just absurd. We've been here before. We need a political signal. Now, they did not get the formal invitation. That was never going to be the case, but they wanted that political indications. The Ukrainians manifested that they wanted stronger language, and they did not get it. But nonetheless, I would point to a conversation I had with a very senior European official who said, was it a success? Will they walk away with weapons, funding, and a G7 commitment? Did they get everything they wanted? No. But again, it was about managing those expectations, and those weapons, funding, that will be crucial for the counteroffensive.
Maria, thanks so much, Maria Tadeo. They're in Vilnius, Lithuania. Coming up, our weekly Bloomberg UK show. In the spotlight this week, a boost for startups, a listing rules shakeup, and an exclusive interview with TikTok.